Hello, I'm Tom. Welcome to the Christian Entrepreneur Seminar, Session 2, Business and Accounting. Every once in a while in the prison, someone will ask me if they can put down that they've been to business school after being at the seminar. And I'll say, well, business school is a 4-year thing. It consists of lots of courses, 4 units of accounting, managerial finance, management, marketing, HR studies, that sort of thing. Strategic management. There's a lot of stuff that goes into it that I can't go into in the short time that we have. But I do present these two short courses on business and accounting, Business 2525 and Accounting 2525, because there's no way we have time to do Business 101 and Accounting 101. One of the things that you'll learn in business class right away is that businesses always have an owner. That owner is whoever it is that has put the capital or the money into the business to get it started. They put their capital into a business venture expecting a return on investment. Riskless assets do not pay much return on investment, or ROI. In other words, you put your money in the bank, what do you get? I don't know, 1% or 2% or something like that. Basically, banks don't pay much, but they're very safe. If you want more return on investment, you usually have to ratchet up the risk. You have to buy bonds or stocks or real estate or something like that. So the lesson here is if you have little capital and you desire to grow it and make a living from it, you should probably invest in a business venture. You can start a business with a very small amount of money if you've got the right idea. If you only have a small amount of capital and you start a business, you have made the riskiest, sane investment there is. And you remember the parable of talents and how Jesus was trying to help people to understand they need to get out there and do something with what God has given us. If you're going to start a business, you probably start it as a proprietorship. A proprietorship has just one owner. So a person like Joe goes out and starts a business, Joe's detritus. Now, detritus is stuff that falls. The basic dictionary definition of it is soil or stuff that you find on the forest floor or something like that. I believe they also call everything at the bottom of the ocean detritus, and it's things that fall down and just end up being stuff that's on the bottom of somewhere. So Joe starts a business. He's going to sell this stuff. It's probably not a great business idea. But Joe starts that. He's a sole owner, and he has full liability. That means he's a proprietor. What does full liability mean? It means that Joe is doing business as Joe. It's just Joe out there doing business. And so if Joe hurts somebody with his business and he gets sued, he could end up losing everything he has. He has no liability protection at all. And so Joe reports his income and expenses on Schedule C of Form 1040. Everybody knows what a Form 1040 is in the federal government in the United States. And you report your income and expenses on Schedule C. A partnership. If Joe goes into partnership with Sam and starts a partnership, then that's a different kind of a business. Basically, it's more than one owner with full liability. There is always a partnership agreement. You can't have a partnership without a partnership agreement, a contract that says you do this, you do that, you're bringing this to the business, I'm bringing that to the business. And then you report that on Form 1065 and K1 of Form 1040. Now, if you're considering going into a business partnership, I have to caution you. Business partner is the next closest thing to a marriage that you will ever experience, except you will not have the love. You will spend a lot of time with and have a lot of disagreements with a business partner over the years, so choose your business partner carefully. If there is ever a murder, the police first question the spouse, and second, they question the business partner, and that's only because they didn't know there was a business partner until they questioned the spouse. So choose your business partner carefully. You could also have a corporation or an entity structure of some kind. They always end in Inc., LLC, PA, LLP, or something like that here in the United States. In other countries, if it's a Spanish-speaking country, a lot of times it's SA de CV. I don't even know what that means. In Germany, it's GmbH. In Britain, or members of the Commonwealth, it'll end in LTD for limited. And what it means is that the owners of that entity are protected from direct liability for actions of the entity. In other words, the owners only have at risk what their actual investment is, not their entire financial self. And taxes are always filed on Form 1120, which is like a 1040 for a business. If the business passes money directly on to its stockholders, its owners, it will report those on a 1099 div. No company can exist without a product. Calvin Coolidge, former president of the United States, said, "No enterprise can exist for itself alone. It ministers to some great need. It performs some great service, not for itself, but for others, or failing therein, it ceases to be profitable and ceases to exist. Calvin was a pretty smart guy in some ways, and that is literally what you do in business. You go out and you serve someone else's need in a better way than they could do it because you have certain equipment, you have certain talents, you have certain knowledge, there's services or goods that you can provide for them that they cannot get for themselves. Business is what allows us to not all have to do our own blacksmithing and not have to churn our own butter and not have to bake our own bread and all the other things that we need in daily life. Business 101 always begins with find a need and fill it and serve your customers. Now, business needs a way of keeping score, and that's what accounting is. You can do full-on double-entry bookkeeping. Businesses end up doing that. I didn't do that for the first few years in my industrial machinery parts business. I just kept track of my expenses and my sales and everything on spreadsheets, and you certainly can do that. It's much harder to track things, and what ultimately pushed me to do double-entry bookkeeping was I was just falling apart on trying to track invoices, what needed to be paid to suppliers that had me on terms that I could pay after I received the product, and what customers owed me and when to send out reminders. So that's what pushed me into double-entry bookkeeping. But however you do it, the definitions are the same in accounting. How much money you took in is called revenue or sales, the top line. What you spent to earn it is called costs or expenses, and what you have left at the end of the year is called profit. And then you pay taxes on that. From your profit, you can pay yourself money, which in a proprietorship or a partnership they call draw. Corporation might pay you a wage or a salary as well as a dividend, or you can reinvest that money in the business. Any investments that you make in the business are done with after-tax money. So if you're buying a building or you're doing research and development on a product or something like that, that's done with after-tax money. It's very important to understand how revenues and costs work and what the definitions of them are. So the sale price minus the cost to produce or procure, the direct cost, that's called margin. So if I buy something in my business for $1 and I sell it for $3, I made $2 on it, right? Not exactly. I made $2 of margin on it. Out of that, then I pay my costs and stuff, right, that are not direct to the product. So margin and profit are two different things. Profit's what you have left over when you get to the end of your reporting period, a quarter, month, year, whatever, whereas margin is the amount that goes to pay the expenses of the business. So our example is Joe and his detritus business costs $6 a pound, pays a temp $1 a pound to package it up for him, and he sells it for $10 a pound. So his gross margin on detritus is $3 or 30%. So that's how you figure margin. So what's a reasonable margin? Grocery stores typically operate on 4 to 5, 6% margins all the time. I have seen some products that sell at 90 or 85% margins. You can argue that that's immoral if you want, but I will tell you the circumstance and you might understand. Variable cost, now this is not the direct cost of the product, but variable cost changes with the amount of business that you do. For example, electricity to run equipment in the plant. If you are running a business in which you need to flex the size of the workforce seasonally, so if I have to bring in seasonal workers, but they're charging their time to work orders, they're actually working on things for sale, then their direct costs. If they're support workers, they clean the factory or they repair equipment or something like that, then they might be in the area of variable costs. Fixed costs don't vary over time. Things like mortgages, the office electricity, copier toner, the internet bill, the phone bill, that sort of thing. Those are fixed costs. And so the way this behaves in terms of what the flow looks like is every order that you create a direct cost bucket and you create a variable cost bucket. The revenue, the money that you collect from the customer, flows first into the direct cost bucket. It pays for the product itself. Then it pays the variable cost. It pays for the support of the procurement or the production process. And then it flows to the catch-all pan, which is all the other expenses, the fixed expenses. And then, if for some reason, some crazy thing happens and you actually have money left after paying all those bills, then you have a profit. The money flow for a business looks like this. You have sales revenue. That's all the money you collect from customers for the product that you sell. minus returns equals net sales. Now also up here at the top, you're also going to have any freight charges that you charge to customers. Then you subtract out the cost of goods sold, which includes what it costs you to buy, manufacture, get it to your facility, the packaging, all of the things that now go into your product as part of your cost of goods sold, and then that will turn up in your gross margin. Then you take off warranty, spoilage, and shrinkage. So warranty expense, you understand what that is. Spoilage, obviously, if you have some product that has an expiration date or you're dealing with fresh food or fish or something like that, spoilage is going to cut into your total net margin. And shrinkage, which shrinkage? Well, you know what? If stuff's sitting around in the warehouse, sometimes some of it just disappears. You can't find it or whatever happened. In addition to that, you may need to scrap some product out. So that'll all go into the net margin. So then net margin minus the variable costs, that's like the electricity to run your factory, selling expense, commissions, bad debt, maybe people that clean the factory, stuff like that. That all goes into the contribution margin. Now, why do we care about contribution margin? Contribution margin is actually really important because that is the absolute smallest amount you can actually sell your product for and make any sort of contribution to fixed cost depreciation, creating profit or anything like that. So if you don't have a positive contribution margin, then there is no way to rescue yourself by selling at greater volume, because you must have enough contribution margin to take an order and have any chance of making any money. So it's very important to understand what that is. So contribution margin minus fixed costs, which we talked about, rent, phone, internet, copier, toner, salaries, etc. So then we have profit from operations, what they call EBITDA. EBITDA is an acronym that stands for earnings before interest, taxes, depreciation, and amortization. Some people call it earnings before bad stuff. So basically it's a way to sort of get at a true and pure look at what the actual operation generates in terms of a contribution to profit. It's just a shorthand way of looking at, if I didn't have all this other stuff going on, what would the business actually make? So let's say I'm going out to buy a machine. Let's say that machine cost me $30,000 and I expect it to last 10 years. I took money out of my profits, out of my earnings from the company, and I went and bought this machine for $30,000. The government is going to let me take the cost of that machine over a number of years as expense, so I can deduct it from my taxes over that period of time. So the simplest way is, if I take a $30,000 machine and I expect it to last 10 years, is to write off $3,000 every year on my taxes. Now, depreciation is much more complicated than that, and it needs a tax professional, which I am not, but that's the general idea. And then we have taxable profit. So we get all done taking all the deductions and laying out all our costs and all that stuff. Now we got taxable profit. Then we're going to pay taxes on that. What are taxes? Well, combined rate in Illinois now for state and federal is coming up on the neighborhood of around 50%. Now that's the corporate tax rate. So if you're a proprietor or a partner, then you'll report on the appropriate form, attach that to your 1040, and you will pay the personal income tax rate on that. So then you have your after-tax profit. Now what can you do with your after-tax profit? You can make capital expenditures. You can buy machinery and buildings. You can do research and development. You can do basic research, or you can actually develop new products. Certain non-deductible expenses, like for example, half of the meals are not deductible. And meals are only deductible if they're on overnight travel for business purposes. And half of meals are not deductible. The idea there is you'd have to eat anyway. There is no longer any deduction for business entertainment. So like Super Bowl tickets used to be tax deductible if a corporation bought them. Now they're not. Corporations still buy them, but now they're not tax deductible anymore. So after you get done with all that stuff, now you got a profit. So then what can you do with your profit? You can pay dividends back to your stockholders. Whatever you don't pay out to the stockholders in dividends remains with the company as retained earnings. And we'll talk about that when we talk about balance sheets a little bit later. What governs how you can log all this stuff, what is called the generally accepted accounting principles, of which I am no expert, and therefore you need an accounting professional in order to actually do your books if you want to do them totally according to Hoyle. If you're small and it's just you and you're very careful about doing it correctly, you can do the accounting yourself, and it's not a ridiculously difficult task, especially when a business is small. At the end of each period, you'll have a profit and loss statement that basically lays out the money exactly the way I just gave it to you, or in a very similar form, so that you can see whether you made any money during that month, during that quarter, during that year, etc. Then you'll also have another report called a balance sheet. The balance sheet helps you to understand what the structure of the business is and where you are at in a particular point in time. The profit and loss statement shows you what happened over a period of time. The balance sheet is a snapshot at a particular date in time. If you look, there's two sides to the balance sheet. Okay, why do we call it a balance sheet? Because the two sides have to match up. They have to balance. So on the left side of the balance sheet, we have assets. So the first asset is cash. If you have money in the bank, that's an asset. Receivables, that means money that customers owe you that are going to pay in the next probably 90 days or so. Inventory. So if I've got products sitting around that I can sell, that's obviously an asset. I can turn that into cash. And then any investments that I have. Depends on whether they're long-term or short-term investments. If I have money that's in a savings account, businesses can own savings account, by the way. Businesses can also own investments. They can own mutual funds or other stuff like that. If they want, they can own gold or cryptocurrency or whatever they want to own. It's a way of managing their cash. It depends on whether those are long-term or short-term investments, whether they turn up in short-term assets or liquid assets, or they turn up in illiquid assets or longer-term assets. And then property, plant, or equipment is always considered to be longer-term assets. And then some businesses will carry other things on their books, like if they buy a company, value that company's trademark or name or their relationship that they have with their customers at the time that they buy that business, then that'll show up as goodwill or something like that. Trademarks and patents and stuff like that. On the left side, we had receivables. That's the money people owe us. On the right side, we have payables, the money we owe our suppliers. Operating loans, obviously, that's money that we owe. Long-term debt, like mortgages and so on, that's obviously money that we owe. And then we have retained earnings, and you also have owner's equity over there. All right, so what's retained earnings? Remember I said if you get to the end of the year and you don't disperse all your profits, it shows up on retained earnings on that side of the balance sheet. And then you'll have owner's equity. What's owner's equity? At the time that we started this business, this is how much money the owners brought to the table. How does this end up working in real life? So let's say, for example, you start a business. You bring $1,000 into the business. So you put that in the business bank account, and now where's that on the balance sheet? Under assets, cash. Where is it on the other side of the balance sheet? Remember I said the balance sheet got a balance? Owner's equity. So now we take $500 and we go buy some piece of equipment that we need for the business. So now we take the $500 out of cash and we move it to where? We're going to move it down to property, plant, and equipment. We take another $300 and we go buy product that we're going to sell. Now we take money out of cash and put it in inventory. If we didn't pay the bill yet, right, it isn't out of our bank account, but we put it on the other side as a payable. The interesting thing is the way that we do business here in the United States and the way that everybody does business. If you have customers that are on terms, in other words, they owe you money, and you're on terms with your suppliers, you owe people money. When business is slow, you have a lot of bills and you don't have any money. When business is good, you have a lot of bills. You owe a lot of people money. A lot of people owe you money. On paper, you're making a lot of money, so you pay a lot of taxes, but you don't have any money because it's all tied up in the flow. The time when business owners are the most rich is when the business is kind of slowing down and their old receivables are getting paid and they're not creating more new payables or not as many new payables. That's when businesses get cash rich. Now, most business owners realize that's also when you need to hang on to that money because it's getting slow and you might need to make it through some months where you don't make a lot of money. When a business is ramping up, it consumes cash. It just consumes cash because your payables are going up, your receivables are going up, you're spending a lot of money on variable costs and all that kind of thing. So when a business is growing, that's when it needs money. I'm not going to go into the supplement information right now. I'll put up a separate video on that. But I will thank you for paying attention here for session 2. You can either go on to the supplement right now or you can do that at some other time. And we'll see you back for session 3.